What if I told you Tesla didn't just survive because of groundbreaking technology, but because of a wild crypto gamble and a government loophole? Behind the sleek cars lies a financial playbook few ever saw coming. Stick around, because what saved Tesla isn't what you think. Tesla Motors wasn't Elon Musk's creation. In 2003, two engineers, Martin Eberhard and Mark Tarpenning, had one mission: build a sexy, fast, fully electric car. A Silicon Valley iPod on wheels, but they didn't have the millions it would take to launch a car company from scratch. What they had was a vision. That vision caught the eye of a man with both money and momentum: Elon Musk. He had just cashed out of PayPal with hundreds of millions. Known already for his ambition, he was looking for his next mission. He invested $6.5 million in Tesla in 2004, becoming chairman of the board. What began as a promising partnership soon unraveled. Musk and Eberhard clashed over nearly everything: deadlines, design choices, and the direction of the company. The power struggle ended in 2007 when Eberhard was forced out. Elon Musk wasn't just funding Tesla anymore, he was reshaping it. And by 2008, amid internal chaos and financial doom, Musk became CEO. The Tesla Roadster launched in 2008, a sleek electric sports car based on a Lotus Elise chassis, capable of going 0 to 60 in under 4 seconds. It made headlines, but under the hood, problems: battery overheating, cost overruns, delivery delays, and then the global financial crisis hit. Tesla was burning through cash. With no mass production in place and only hundreds of Roadsters delivered, bankruptcy was weeks away. Musk poured in his own money, even borrowing from friends. It was desperation mode. A lifeline came in the form of a $465 million loan from the U.S. Department of Energy. That kept Tesla alive, but survival wasn't success. In 2012, Tesla launched the Model S, a make-or-break moment. It was their first in-house design from the ground up. Long range, minimalist interior, over-the-air updates. Critics raved. Tesla won Car of the Year. For the first time, the world saw Tesla as a serious contender. But as demand rose, profits didn't. Tesla was growing fast, but bleeding money even faster. Then came the Model 3. Tesla wasn't just building another car, it was making a bet on the future. A $35,000 all-electric sedan, sleek and minimalist, aimed squarely at the mass market. This wasn't a luxury toy for the rich. It was designed to make gas-powered cars obsolete, to push electric vehicles into the mainstream, and reshape the auto industry from the ground up. But there was one massive problem. Tesla had never built anything at this scale. Production ramped up, then broke down. Suppliers missed deadlines. Robots didn't work. Cars piled up in parking lots, half-finished. Meanwhile, the company was bleeding cash. Tesla burned through nearly $1 billion per quarter, building gigafactories in Nevada, Shanghai, and later Berlin. Each one was a moonshot, vertically integrated, AI-driven, and obsessively efficient, at least in theory. Investors remained hopeful, but cracks were showing. Tesla's valuation soared like a tech company, but inside it still operated like a fragile startup. Missed targets, layoffs, lawsuits. Musk even tweeted that the company was about a month from bankruptcy during the worst of it. And then came 2020. The COVID-19 pandemic shut down supply chains, froze factory floors, and sent the auto industry into freefall. Legacy automakers scrambled to survive. Tesla's future looked more uncertain than ever, but instead of collapsing, something unexpected happened. Instead of collapsing during the pandemic, Tesla did the unthinkable. While major automakers like Ford and GM posted multi-billion-dollar losses, Tesla reported profits. But those profits didn't come from building and selling cars. At least, not entirely. In early 2021, Tesla revealed a bold and baffling move. It had purchased $1.5 billion worth of Bitcoin. The crypto market surged. A few weeks later, Tesla sold 10% of its holdings, netting over $100 million in pure profit. The move shocked Wall Street. Critics called it irresponsible, a gamble, a distraction. Musk called it a liquidity test. But in that moment, Tesla looked like a company willing to play by its own rules and win. Bitcoin wasn't the only ace up Tesla's sleeve. Behind the scenes, the company had quietly become the world's largest seller of regulatory carbon credits. These credits, essentially pollution passes, were bought by legacy automakers who couldn't meet emissions standards. In 2020 alone, Tesla made $1.6 billion from carbon credits. That was more than all of its vehicle profits combined. While Tesla's finances stabilized, its next big bet was full self-driving. Autopilot was pitched as revolutionary, but reality lagged behind the branding. The system still required driver attention, yet accidents piled up. Lawsuits followed. Regulators pushed back. But Tesla didn't retreat. It doubled down, rolling out FSD beta to thousands of users, turning customers into live test drivers. Controversial, yes, but it gave Tesla something no one else had: massive real-world driving data. And behind it all, Musk. His tweets moved markets. His interviews fed headlines. His persona became inseparable from the brand. To some, he was a genius disruptor. To others, a liability on a leash. Yet, the hype worked. Tesla spent almost nothing on traditional ads. But thanks to Musk, it was the most talked about car company on Earth. Tesla's rise wasn't just a story of innovation. It was a masterclass in survival, risk, and financial jujitsu. The future may be electric, but Tesla's past? It was powered by vision, volatility, and a few billion in carbon credits. Thanks for watching Tesla's story. If you believe in learning from the greats, if you believe success leaves clues, then you're in the right place. This is how. History, opportunity, wealth. Every success has a story. Subscribe so you never miss the next one.